Welcome back to Hong Kong and the Credit Suisse Asian Investment Conference, where we're taking a closer look at the Chinese property markets. And joining me now is Credit Suisse Chinese property analyst, Jinsong. Jinsong, thanks very much for joining us.
Thank you.
You hold a non-consensus view on the prospects of the Chinese property market. Give us a little bit of an idea of where we stand right now.
Sure. The consensus believe that the valuation of the sector is very cheap, and the policy, the tightening measures may not be there anymore because of the macro uncertainties in the economy. But we believe that, number one, the valuations may not be expensive, but if you compare to the historical low levels such as 2008, it's still, there's a large gap between the valuation right now and 2008. And also at the same time, maybe more importantly, we believe the policies will still be there despite of the macroeconomic uncertainties, because the Chinese government's key concern this year is inflation, and to constrain the inflation, they have to bring down the property prices. Also, from a macro perspective, the Chinese government want to encourage domestic consumption, and they believe that a high property price is actually detrimental to domestic consumption because everybody will be saving for housing rather than consume.
I've also read that between 50 and 60% of China's GDP is construction. Does that tie in then with creating more supply and keeping prices lower?
Yeah, that's actually another reason why the bullish camp believe that the Chinese government won't come down too hard on the sector, because if the sector is weakened, then the GDP growth may be affected. However, this year is different because the government has announced a 10 million units construction for public housing. So the government actually believe, we actually talked to the government officials last Friday in Beijing, and they believe that the massive increase in public housing investment will more than compensate in any weakness of the private sector, even if the property prices drop and construction in the private housing slows.
So would you be more then in line with people who, since over a year now, like Jim Chanos, have been saying the Chinese property market's 1,000 times worse than Dubai? For him personally, it must have been a losing bet because he's been short far too long. But
right. I think that it is probably an exaggeration that is 1,000 times worse than Dubai. I think overall, all the long term, because of urbanization and because of the China's hopefully long-term growth, the problem is probably not. We're probably not going to see a total crash of the whole market. However, because of the sky high the property prices compared to the affordability, we do think that the government is managing a soft landing in terms of using the policies to bring down the property prices. We think that is visible, and because of that, some of the property names valuations are still high because people are still using an assumption that property prices will continue to go up every single year to calculate what we call the NAV, the net asset value.
That was Jinsong, Chinese property analyst at Credit Suisse and moderator of today's Chinese property panel.